there's a heap of stuff online at the moment that I've seen that's been fed to me, Facebook groups, I don't know, Instagram reels and stuff around this property growth. And I want to ask you, what's the deal? I've seen people out there promoting, over 10% returns year on year for property. I've seen them saying maybe 6 or 7% yield per year. This is out in June, so mid-year. What should we do when we hear these things, and how do we respond? And what are you seeing out there is in terms of property strategy, what could be considered a reasonable guide?
Yeah, like these promises or guarantees or whatever high-level marketing, it's not new. It's been around for 100 years. You look back in the last 5 years and say, well, some suburbs, areas, dwelling types have gone up 150%. So that's 30% a year. So to go in and say, I'll promise 10% would have been
pretty good, easy.
not too much trouble. I think generally if you look at Australian real estate, you probably pin it around 7% on an annualised basis. We sort of forecast on minimum sort of 5% to be conservative. So if you're looking at something that says, well, I'll guarantee you 10%, the word guarantee is obviously a red flag, but 10% is probably not what I'd do my forecasting on. And then the yields, which is the rental, the 6 to 7 yield means that it's basically positive cash flow or very close to. We would expect in city locations, like definitely in Sydney, probably under 3%. In most other capital cities, probably just shy of 4%. Coastal towns, regional, we're probably around about 4%, a little bit more. And then the rest of the regions maybe closer to 5%. So 6 to 7 is quite high and not the norm.
And if you are going to different companies who are giving property strategy and whatnot, and they're talking about these high yields and high returns as part of the sales pitch, should there be some caution?
Well, there's definitely caution, and I suppose the key is asking the right questions. Okay, where are we getting this information from? Historically, have you seen that? And if they go back 5 years, they may have seen that. Yeah. That's the issue. We need to go back longer than that. And just because it has had that historical growth doesn't mean it's going to continue that way. And that's probably the bigger issue at play at the minute. There's a lot of investors that have had maybe beginner's luck, might have been strategy, might have been research, but either way they've ended up in a far better position than they thought. So they're saying, well, why don't I just double down on that? Now, because it's crept ahead so far compared to household income, a lot of these locations can't continue the way they've come from, the way they've gone. So, yeah, it's interesting times where there's a lot more time required to start analysing property because it was so affordable prior to this 5-year growth period.
Yeah, I saw a case study. It was a property person talking about it, and they were saying there was like a single woman earning 90 grand or something, and it was something like bought 3 properties or something in a year. I mean, and it was kind of these returns were in the same type of conversation. But like when I see that, I'm like, something's not right. And my obvious first response is, well, they've set up a separate entity to get around potential servicing issues.
With the 3 properties?
Yeah, or
$90 grand a year to get 3 properties, depending on what the price of the properties are. But, yeah, there may have been a trust, which has been a hot topic of late. But, again, banks are pulling back on that sort of stuff. Yeah, who knows? Pay slips, who knows what goes on in the world. But where there's a will, there's a way, I think, in a lot of cases. But I think if you strip this back and say, okay, I've seen an ad that says 10% returns per year on year with a 6 to 7% yield, that's a marketing headline. are you looking at the overall strategy and what price is that? What location is that? What type of property is that? What's the vacancy rates like? What's supply and demand look like? What's it forecasted to do?
Yeah.
All these questions to
And
ask.
I think I wanted to ask you about this because my feed has just been flogging with ads from people promoting self-managed super fund, property. If you don't get this return within this amount of time, we'll refund it.
Yeah.
All this crazy stuff. And
yeah, it's red flags.
yeah.
And you probably clicked on one, which meant that 100 others come to your party.
That's what I hate about the feed. It's like I watch one engineering video on how a bridge is made, and then like YouTube thinks I want to be an engineer. Like it's just it's annoying.
And in self-managed super, you're going to need at least 6% yield even just to cover the running costs with interest rates the way they are. So yeah, there's a lot of red flags in all of that. I suppose highlight headlines, but it's just stripping it back and saying, what questions do I need to ask?
Okay, so someone who's just lobbed in and listened to us for the first time, they'll be like, what are you talking about yield? So yield is the return on the property.
Yeah, so it's
pre-tax.
Let's dumb it down even further and say, well, it's rent per week times by 52 weeks in the year divided by your purchase price.
Okay, or what we could do is, say if we do a $875 purchase price near a cap city, then we go times 3.5%. Or this is Central Coast or something.
Yeah, 3.5.
Yep, times 3.5% divided by 52. That's going to be about $588 a week rent.
Yeah,
for about an $800K property purchase price.
Yeah.
So
now where, and I don't want to go too deep into the weeds here, but where people come into trouble there is they say, well, okay, that's a gap in itself already. But depending on what my loan amount is there is the bigger issue, because second-time investors, they're using the equity from their 5-year growth period to go and get into the second property using 105% of the bank's money because you got stamp duty. So then the holding cost on that 3.5% yielding property, whilst it might be a great area or even a great asset, it might be $3,000 a month.
Yeah, and I think I don't know, it's just there's been a lot going on that I've seen online. I've had a property that I own go up for re-rent, and I put it up for, I think, $780 a week rent.
Yeah.
In the same building, and within 2 blocks of that, there was equivalent ones going for over $900.
Yeah.
And I don't know, this is the dance with, I just don't want to rip people. Like, I don't know.
Well, there could be one-off occurrences because there was nothing else on the market. But, yeah, you've got to be fair and reasonable. But if you put your rent as a yield into what it's worth today, it's probably going to be early threes.
Okay, well, let's have a look. So 780 times 52 gives us 40 grand. And let's just assume divided by 960, that's 4.2.
Okay, so which is townhouse, so it's going to be a little bit higher.
Well, no, it's up here, the apartment.
Oh, even better. Yeah. So smaller land size, smaller land value, meaning the yields are going to be greater. So again, without knowing where this came from, this 10% return, 6 to 7% yield would generally be seen or marketed around smaller dwellings.
Right.
Because the yields are higher because the internal size is smaller.
And I guess, for example, if I borrowed if I had a house on a block and I built a granny flat for 200 grand, right? And I charge, $350 a week rent to someone, 350 times 52, 18 grand a year, divided by 200,000, that's a 9% yield.
Yeah, so that's where a dual occupancy, so two dwellings or a house and a granny flat, you might be starting to get up to those 6 or 7s. So, it could be some of that as well. But
I think I just want to reaffirm to everyone that at the very least, there should be an amber flag if you're getting marketed to with any type of guarantee or cash back if we can't achieve.
Yeah, okay.
Now, that doesn't mean it's illegal.
No.
It just means I'm personally not comfortable to engage in that stuff, but it's just part of your due diligence.
Yeah, it's just if you need to guarantee something, you just got to continue to ask more questions.
Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.